All right, well, good afternoon, everybody. Welcome. My name is Mohammed Ali here. We're basically going to be doing a continuous monthly financial literacy talk. Um, the purpose of these meetings is basically, or these informal discussions here is basically to educate, our viewers. There's a big gap in our community, especially about talking about finance. It's a very sensitive topic. A lot of either newcomers are not familiar with how the system here works in terms of credit, financing, and so on and so forth. So we're trying to kind of cover new topics every month and give everybody kind of a platform where they can come in, share questions, even network, right? There's a lot of folks here that we have a guest speaker every month, and they come in, they kind of share their insights about finance and personal finance. A lot of times we focus on, and we'll kind of go from there. Alrighty, so for today, we're going to be covering several things, including some terminology, some financial terminology terms. Big one that everyone has kind of been talking about a lot is RRSP versus TFSA. So we're going to go over that, what they mean, and then where to contribute for each, right? When is it useful to use each one? Sorry, I'm hearing some noise, a lot of noise in the back there. Alrighty, sorry about that, guys. So we ask everyone just, you stay muted if you can until you're basically, if you have any questions, just definitely leave it till the end, and we can we all go over it and cover it. We always leave a big section there. So, step number 7 there is Q&As, guys. So don't sweat it. Okay, you'll have your time to speak. So yeah, we're going to talk about RRSP versus TFSA, where to contribute for each. We're going to kind of give you guys some tips on, where to put your money for each of those. We're going to talk about something called the compounding effect, right? This is a very, very important term. Compounding can happen in a good way or in a bad way. We're going to cover both sides of it, and we'll try to get you guys on the right side of that equation, okay? And like always, we're going to finish it off with a market review. This basically does a quick little overview of where interest rates are, a little bit on where the housing market is. It's just very, very high level. It kind of just keeps you guys informed on a month-to-month basis on where things are going. And lastly, like I said, we're going to talk about some sections about Q&A. So we ask everybody, please put all your questions on the chat, and we'll definitely go over them at the end. Alrighty. All right. So for ourselves for today, it's myself, Mohammed Ali. We have Mohammed Mahmoud. He's a mortgage agent. He's a specialist with Dominion Lending. And our guest speaker for today is Mu'taz Dirar. He's with Edward Jones. He's expert in personal finance. He has a lot of insight. We had a chat a few days back, and he's very knowledgeable. He's a great asset. Make sure you guys, I made sure I put even the numbers and email there. Like, it's right away, take that number, guys. You essentially have a direct network with the folk, from Edward Jones, and he'll be able to share some insight for you there even afterwards, okay? Feel free, guys, Mudo and Mu'taz, to just jump right in whenever you guys feel like. It's completely informal, all right? So I know personal finance is a very sensitive topic, guys, right? You're talking about where your credit is, where your family situation is, what your goals are. And we understand that, right? And we always tell folks that this is going to be a quiet. Oh, I feel like I might. Sorry, guys, give me 1 sec here. Allow participants to unmute themselves. There you go. Sorry, Mudo. He just called.
No worries. Still working out this technology stuff, right?
He basically called me to tell me to shut up, right? Like, stop talking so much and let me talk. Mu'taz and Mohammed, jump in, guys. But yeah, so privacy is a big concern, right? I know a lot of the stigma with our community. We all talk and stuff. Absolutely not a chance here, right? Mudo, myself, Mu'taz, we all know how sensitive these topics can get. You're putting your family's goals and finances out there, so keep in mind that anything that is talked upon, obviously here it's going to be public. So talk to us personally if it's something that is personal, guys. If you do have a personal question, feel free to give us a shout, and expect your privacy to be adhered to. Okay. All right, guys. So just to start things off, we're going to be jumping into some high-level terminologies here, basically, right? These are just some of the things we're going to be talking about, and we're not sure where our viewers are at in terms of their financial literacy. So that's why I wanted to just cover some just high-level terms. And then once we jump in deep into the presentation, if you do come across something, you are allowed to unmute yourself, guys, and maybe ask a quick question. But we ask just so the presentation is more smooth, preferably to just leave it at the end. Okay. If there's something you didn't understand in terms of a word, feel free to just ask. Here are just some.
And
Go ahead.
if you feel like you already know these terms, that's okay, because some of us might be at different levels than others. We will be updating these terms as we go in future sessions, just so we can help with the understanding while we're presenting the session. Still, if you do find terms during the session that you're not familiar with, just feel free to jump in and ask, or put it in the chat section and we can address it in the end, inshallah.
Inshallah. So yeah, what is a loan? I think that is borrowed, especially a sum of money that is expected to pay back with interest. All right. What is the principal part of the loan? Right. So the principal part is the money that is originally agreed to pay back. Interest is the cost of borrowing the principal. Okay. So you're going to hear us say principal. It is the loan essentially. And then there's so when you make a minimum payment, you're going to see there's a portion that goes towards the principal. There's a portion that goes towards the actual interest, right? Servicing the debt itself. Equity, ownership of an asset, a company or a home can be a partial ownership, right? So you can partially own a home or partially own a stock. In case you hear that word, now you know. This one is a little tricky. It's tax bracket. So total income is split into ranges, which are taxed at different increments, okay? Typically at higher incomes, each dollar is taxed more, not the full amount is taxed more, guys, right? Just that extra incremental increase of income gets taxed at a higher percentage, right? So that's the idea here. And again, we're gonna maybe come across some terms there. So if you guys have any questions, like I said, leave it in the chat, please. Do you want to start taking over here, Modu?
Yeah, sure. So something we thought that it's pretty basic and important for us to know is when you want to kind of like save your money, you're thinking, where do I save my money? Or even if you're thinking of investing, where do I invest my money? So we might have heard of accounts like RRSP or TFSA. Some of us might not be familiar with what these accounts are for. So to start off, like RRSP, what does that stand for? It stands for Registered Retirement Savings Plan. This is basically an account that was developed for basically for retirement. So you put your money into this account, and the first benefit for it is that it's tax deductible, which means any money that you put in there, it's immediately deducted from your income, so you're not taxed. So let's say you're making 50,000 a year. You decide to put 5,000 a year in this account, which is an RSP. At the end of the year, instead of being taxed for your whole income, which is 50%, you're taxed for 45% because there's a 5% that's sheltered in your RRSP account. So this is the main advantage for this account, but it also has some other advantages, especially for instance, homeowners. So if you're a first-time home buyer and you want to save your down payment, you can actually put your money into this account, the RRSP account, and it's sheltered. So first of all, it's tax sheltered. You pay less taxes when tax seasons come. The second thing is you can actually save up to 35,000 into this account and use it for your down payment in the future. Because when it comes to an RSP, any money that you have in there, if you want to withdraw that amount, you're actually taxed. So you pay like you end up paying kind of like a penalty just for taking the money out. So there are only specific instances where you can take that money out. One of those is if you're taking it for a down payment on your first home, so up to 35,000. The second scenario where you're able to take out that money is when it's for lifelong learning. So let's say you want to take it out, you want to start school, master's or something like that. You can take out that money without being penalized as well. And the third scenario, because this plan was basically started for people for retirement. So when the time comes and you want to retire, when you take this money out, it will be added to your income. But just because at retirement, you're basically, your income will be low because you're retired, right? So even if it is added to your income, it won't be much higher of an income. So it won't be taxed. The tax bracket you will be in won't be much. So I would say these are the basic things to know about an RSP. If you are thinking of saving or even investing, if you're employed with a company that matches your RSP, so we have these companies that if you, let's say, put 10,000 into your RSP account, there are companies that will actually match it for you. So you put 10,000, they will put another 10,000. So now you have 20,000 in your RSPs. So this is basically free money just because you decided to put money into your RSP. It's tax sheltered. Another benefit is you can use this money towards investments. So you can, for instance, talk to a financial planner like we have Martez Delal here today. You can tell Martez, hey, I have this money in RSP. I want to invest it. What do you think? So there are multiple ways to do it. You can invest it yourself if you feel like you're confident and knowledgeable enough to do so. You can actually put that money towards stocks, bonds, ETFs, whatever you think is appropriate and you have enough knowledge about. So I would say that's the thing about RSPs. Another account is TFSA. So TFSA stands for Tax-Free Savings Account. This is also an account where you can save your money in and you can also use it for investments, right? So let's say you decided to invest in stocks and you're getting a pretty decent return. That return is not taxed if you're gaining it in a TFSA account. For instance, if you are using your own personal account to invest and you're getting profit from those investments will be considered as investment income and will be taxed accordingly. So a smart thing to do would be to consider putting this into your TFSA account. So whatever income you're getting from that investment, it will be tax-free, and hence the name tax-free savings account. Like the RSP, you can also use it towards different investments. It could be your own investments that you're knowledgeable about and want to invest, or you can consult a financial planner to help you with those investments. Keep in mind that with both the RSPs and TFSAs, you have a limit to how much you can contribute each year. So according to your income, there's a specific amount that you can contribute each year, depending on your specific situation, which your accountant can help with as well. Before we move into the next slide, is there anything, Mohammed or Mu'taz, that you wanted to add here?
No, great coverage, right? So essentially, guys, the RRSP is so it's money any money you put in there is not going to be considered income. So just to go back to your example there, it wasn't a percentage. It was if you make $50,000 and you put 5,000 in an RRSP, now the government is going to look at your income as 45,000 and tax you on 45,000, right? So it'll be a little bit lower than if somebody was getting taxed at $50,000. Okay. Same thing, exactly what you mentioned. The 5,000 goes into that account. Later on is when you ideally want to take it out. Let's say you bought some stocks with an RRSP account, right? Stocks did really well, and now you want to take that money out. So you bought it at 5,000. Let's say it just doubled, right? And then you want to take it out at 10,000. When you do take it out, it's exactly like you mentioned. Any money taken out, it's considered income at any time. Whether you do it now, whether you do it in retirement, it doesn't matter. It's considered as income, which means they look at what you're making. So let's say you made 50,000 the next year, and then you decide to take it out that next year at the 10,000. Now your income is going to be 60,000, right? So you do want to be careful if you're thinking of long-term holding for very long, then which account to use and which not to use. TFSA is you're getting taxed. So 50,000, you get taxed. Let's say 8 or 1,000 get taxed. So now you have 42,000, right? From that 42,000, you put 5,000 in a TFSA account, right? That no matter how much that account grows, dips, whatever, doesn't matter. The government doesn't look at how much you gained, and it does not put any kind of capital gain tax on it or investment tax on it on your investments there. So that's the idea there. Is it's money TFSA, you already got taxed on it. So no matter how much your account grows, you don't have to worry about paying any additional taxes. So great coverage there, Mudo. So the
I just want to jump in, guys. Also, I want to add something. A lot of people then they would say, if I have to pay taxes for RRSP when I withdraw the money later, then what's the point of it? Like, I'm going to pay tax, I'm going to pay tax. So why should I have an RRSP? So there's two benefits for the RRSP. Number one, it allows your money to grow tax sheltered within the account. So you're not paying any taxes like for those number of years before you retire. So let's say you have 30 years before you retire. So for 30 years, you're not paying any taxes, because if you have the money in a non-registered account, then you're going to pay taxes during these 30 years. So in the RRSP, your money is tax sheltered for 30 years. So that's going to have better compounding power on your money. And then number two, normally when people retire, they have lower tax bracket. So let's say before they retire, they were making, let's say, 100,000. And now when they retire, they're making, for example, 60,000. So now the 100,000 and 60,000, they're in different tax brackets. So when you are at 60,000, you pay lower taxes. So that's why when people contribute to RRSPs, they reduce their taxes, because they will pay at a lower tax rate when they start withdrawing at retirement. Hopefully, I mean, not everybody is the same, but this is like just the general rule behind it.
Perfect.
Thank you. Can I add a small point, guys, here?
Sure.
Yeah,
I
just for the
to
viewers there, Hala is an accountant there, so she's very, very knowledgeable.
thank you. I just wanted to add that who can contribute to RRSP and who can contribute to the TFSA. So in order to contribute to an RRSP, you should have an employment income, and you have the room for that, and that's determined by a certain formula. And you can find the contribution room in your notice of assessment every year, as well as the TFSA room. But the TFSA, it has nothing to do with your income. Even if you are not employed, if you don't have an employment income, you have the room on annual basis. Another point is that, I'm sorry. Another point is that when you make the withdrawal from the RRSP, then you lose the room. You cannot get that room back. But in the TFSA, if you made the withdrawal, you can have the room back next year. So you can still use the room if you made the withdrawal. So it's only these 2 points.
Thank you, Hala, there for that extra bit. We'll go over it, what she said again, for those that didn't hear, and I'll explain it again, okay? I just want to go over this next slide, where do you want to contribute ideally? And that's a big question everybody has, right? If you have both options, what do you do? So I know this is a little bit cumbersome here. So there's kind of 5 factors. I found this great source here on moneysense.ca. Definitely recommended for those folks that are trying to learn more about personal finance. The 5 factors essentially boils down to your income, so your tax bracket that you're in, the time horizon, when do you want that money that you're putting aside, something called group plans. So Mudo covered this a little bit, which is if your employer is going to match. This is not something that we can just offer. Here's a matching contribution. No, your employer, right? So it does depend on each person's work status. So we'll go over that a little bit. And if you're buying your first home or saving for education, and if you're heading towards retirement a little sooner than later, okay. The rule of thumb that we kind of seems to work nice is, depending on your income, is if you're making over $50,000. Remember what we said, right? As you make more money, you're getting taxed a little bit higher, right? That extra portion is getting taxed higher. So if you're making over 50,000 a year, you should consider putting your money towards RRSP. If it's under 50,000, then really you're not getting much of a tax advantage. So just put it towards your TFSA, right? Key thing is here, you're always saving, guys, right? If you notice, it's always going somewhere. We don't want you to just go spend it, right? Time horizon. If you're looking for something very long-term, RRSP becomes the go-to. For something like short-term, and this is an interesting one, right? A lot of folks just kind of leave their money in a checking account. You'll find I've come across checking accounts of $20,000 or $30,000, and folks just say, well, just in case, right? What if it's a rainy day? It's not a good idea to keep your money in a checking account, right? It's not doing anything for you. So you're going to work, you're working your 9 to 5, your money's just sitting there not doing anything, right? Let your money also work for you. So put it in a TFSA, buy some, general ETFs, and let the money also work for you, right? Let it earn that 7-8% market average. And what's great is, remember, all of its earnings, you can withdraw it instantly, like Hala said, right? No issues, no penalties. It's already money that's been taxed, so you don't have to worry about anything like that. Okay, so for short term, even your savings, even your emergency funds, TFSA, guys, right? So group plans, what Mudo talked about, if your company is going to match, absolutely see how much they're willing to match and max that out. It's essentially free money. Literally, you know, you put $2,000 a year on it, company matches with another 2,000, instantly you made 100% on your investment, and then whatever else it grows afterwards, right? So it's definitely the way to go. If you're buying your first home in savings, we kind of already talked about that, right? There's a home buyer plan. We've talked about it in previous talks, and RRSP is the way to go. Now, just to cover a little bit there, you have up to 35,000 per spouse, so up to 70,000, right? That you guys can put towards an RRSP essentially, 35,000 each person. And lifelong learning, I'm not sure if there's a limit there. You guys want to jump in and correct me there, but same thing. Both have a payback plan. So if you max out the 35,000, there's a payback period. If I'm not mistaken, is it 15 years, Mudo?
Yeah, it's usually 15 years. That starts usually the year after. So cumulate, like the total would be closer to 17 years because they start counting the 15 years in the year after, maybe 2 years after you withdraw that amount. So you do need to pay at least 1/15 of that amount each year. So let's say you took out 35,000. When that 15 years starts, you would need to like maybe around 2,000 a year at least to pay back, just or otherwise it'll just be added to your income. HALA can also add to this as well. So it is a great plan for those who plan to shelter their taxes plus save for their first time home. It's a great plan.
Perfect. And of course, yeah, if you're just thinking for retirement purposes, definitely RSP is the best. We talked about the tax sheltering advantages there. New tax-free home savings account. Mudo, it's all you.
Yeah. So this is a new plan that just was introduced this year, I guess, with the new government. It's going to start in 2023. There's not too many details about it, but it's also to help. In addition to your RSP, this is an account that will help with your first home that you're buying. So you're allowed to put a maximum of 5,000 up to 5,000 a year into this account to save towards your down payment up to a maximum of 40,000. So this would be a great plan if you maxed out your RSPs at, let's say, 35,000. That's the maximum in your RSPs. You can open an account like this and put another 40,000. So now you have 75,000 as down payment towards your new home. This is also tax deductible. If you put a part of your money here in this account, it will also be tax sheltered. And it won't be taxed in the year that you put it in. This is a few things to know about it. It seems like a good plan. More details will come in 2023, but it will also, I think it comes along nicely with your RSPs as well.
Perfect. All right, guys, so this is probably the most important section right now for the presentation, right? Compounding effect. We've seen so many folks not take advantage of this. It's I think it was Albert Einstein said it was the miracle of life. Essentially, is a compounding effect. Like it's a very, very beneficial. We're gonna go through it here. Mataz here is gonna help us cover this. So compounding effect, guys, or compound interest is the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from the previous period, right? So, or instead of interest, it could also be the earnings, right? So it's not just what it's growing on a simple interest basis or simple return, but also your returns are also getting you more and more returns, right? So you start to see a trajectory that's more exponential. We'll cover that in the next slide.
Yes. So with respect to compound interest or compound growth, I would start with this quote for two quotes actually for Albert Einstein. So he said the eighth wonder of the world is compounding growth. So the eighth wonder, I mean, we know there's 7 wonders of the world. So he said number 8 is compounding growth. And then also he had another quote about it. He said that the most powerful force in the universe is compounding growth. So here's like, like one of the smartest people in human history talking about compounding growth, and he cannot stress it enough, like the importance of it. It's like very, very powerful if you use it to your benefit. The power of compounding is working either way. If you use it, it's work for your benefit. It's working for you, and if you don't use it, then it's working against you by default. Because, for example, the more you delay saving and investing, compounding growth is working against you. The more you delay, it's working against you. The earlier you start, it's working for you. So here in the slide here, we see an example of that. So somebody started invested just right out of school. So at 25 years old, they started investing $5,000 a year. So that's $417 per month. Every month, $417 per month going to an investment account. Doesn't matter which one, tax-free, RRSP, non-registered, whatever. He's getting 8% on it per year, which is like very reasonable rate of return. So this person started investing from 25 until age of 35. So stopped at 35. He got busy, I guess. He had children and a mortgage and all the stuff. So he stopped investing. But he let the money continue to, because the money is still working. The money is still invested. So he stopped putting money in, but the money is still working. So the money is working at 8% still. So the money at the age of 65, the age of retirement for most people here in Canada, he had 787,000. So he only contributed out of his pocket how much? Only 50,000, right? Because the 10 years times the 5,000 per year, that comes to 50,000 out of pocket. And then the 787 is the total. So basically, like he made more than 730,000 in just compounding growth. So that's one thing. And then you compare it to another person who just decided to wait a little bit until the age of 35. So he was like, struggling with his career and didn't make enough money. And like, he had like different reasons why he didn't start right away. So he started at 35. So not much difference, like only 10 years in terms of time. In the grand scheme of things, 10 years is not huge, but in compounding, with the compounding effect, it's a huge difference, as we see here. So he started at 35, so 10 years later, doing the same amount of money, but he's doing it for a longer time. So that person, the first person, he did it only for 10 years. This person has done it for 30 years. So out of pocket, how much he put? He put 150,000, right? So 5,000 per year times 30 years, that's 150,000. So another person, the investor number one, he only put 50,000. So 150,000 versus 50,000. And then both of them are growing at the same rate, 8%. So at the end of the 30 years, investor number two, he had 612,000. So that's like 175,000 less than investor one, and with way more money out of pocket. Like he ended up with less money in the end, $175,000 less, but also investor number two put way more money, put almost like 3 times the what investor number one put. So that just shows you the power of compounding. And this is only 10 years difference. If you have 15 years, 20 years difference, the amount is gonna be way more staggering. It's gonna be way more shocking when you look at the difference. So I just cannot stress enough the power of compounding, because as I said, it's just like gravity. It's a force of the universe. It's there. It's working either with you or against you. You're taking advantage of it. It's working with you. You're not doing anything. It's working against you, actually.
You can continue if you like. You're doing a good job.
You go for it, Ahmed.
No problem. So we added this slide a little bit because we're trying to kind of emphasize the bad here. And I was trying to find a way to explain it. We'll try it this way. But the idea here is, I know it kind of looks a lot is going on, but this is an online calculator. Actually, we're going to do an example if you like right after this. But this is a credit card balance of $1,000. And most credit cards are about, I think, 19% or 19 point something percent. So I just said 20%, make it easier. And the minimum payment here is based on interest plus 1%. So when you click there, it auto-generates the interest payment. So the minimum payment. And you probably have seen this a lot, right? You $1,000, you just bought a brand new computer or whatever. Then you see a minimum payment of $26 or $27. You get all excited. You're like, oh my God, it's like a payment plan. No problem. I'll pay $30 a month and pay it off, over the year, right? You think it's going to be done by the end of the year. But if you actually just pay the minimum payment, you'll find that it carries on for multiple years. So in this specific scenario, it runs for 5 years, right? And yeah, you don't feel bad about it. Like, it's okay, whatever. It's $30, $1,000, whatever. It's 20% interest, whatever. I probably paid like $200. Well, no, you've actually paid close to $600, $580, right? And this is the most common mistake. They think the minimum payment is a good payment or a good enough payment. It is not nearly good enough. Let's take a look what happens if you just nearly doubled your payments, right? I don't know why I picked $50. It's not even double, but close enough, okay? $50, still not much. So let's say you've just, doubled the payment. All of a sudden, you would have paid off that credit card statement in 2 years, in 1 month. And look at the amount of interest you saved, right? It's close to $300 there, right? Or over $300 there, right?
Yeah.
So it's more than half, right? So huge savings just by increasing it by a tad bit more. And the reason for that is the same amount is supposed to go to interest goes to interest. In this example, it's actually about $16 goes to interest, and only $10 is going towards, which is the 1%, is going towards your balance. While here, the same amount is going to your interest, $16, and then the remaining of the $50 goes towards, the $34 goes towards paying back your principal, right? And that's why all of a sudden you see the trajectory is a lot faster, and you can pay down that balance a lot faster. The amount of interest, which is this number here, the dark line, it stays very, very low the whole time through, right? That to us is the most important factor, right? Is do not pay the minimum payment. So one little thing we did, let me know if you guys can still see the screen here. Where is it? This one here. Can you still see the screen, guys?
Yeah, it's good.
Perfect. All right. So I just wanted to show you one simple thing here, right? So 20%, same thing, right? Interest payment, right? We're back to here, right? The 5-year. And this is a simple tool for you guys, right? Calculator.net. If you're going to buy that computer, let's say you just have to absolutely, you're fixated on buying whatever that is for $1,000. The same thing works if it's higher, right? And you don't think you can pay it off in that same year. Our rule of thumb is if you can't pay at least 20% of it back month to month, so it's going to last more than 5 years, then you should either not buy what you're buying because it's clearly you can't afford it at that point, or if you need to, it's for business or work and you need it, then consider other ways of buying it, right? So what we recommend is a line of credit. So we'll leave everything the same here. Credit card interest is about 20%, but let's say you bought it in a line of credit. I think Mudo, you mentioned the line of credit is about 7% interest.
It depends, yeah, but I'll say 6-7% as an average.
No problem. So let's say 7%, guys, right? Just by switching to a 7%, same payments, but you went to a different type of loan, right? So this is a line of credit now. All of a sudden, you've reduced your amount of interest by, by a quarter, essentially, right? And that's the idea here with compounding, right? Is same amount of payments. You didn't change anything, but that's the way of financing that purchase changes. Make sure that you have more money in the bank, right? At the end of the day, you've only paid total $131, of interest in it, right? A very, very common mistake I tend to see, and it's something that I really want to bring to your attention, guys, because it's a very easy way. You can still make your purchase. If you need to make it, go for it. But just a way of carrying the debt instead of carrying it on a credit card, which is absolute the worst. You carry it on a line of credit, for example. All of a sudden changes how much of this interest you pay. So use these tools around you. It's absolutely free. We put the link right here. It's just a regular calculator.net, and you can just use the credit card calculator function they have there. You can just kind of play around with the numbers a little bit and see what they say. The minimum payment is not the payment you should make. You should make 20% of the credit card payment, 30% of the credit card payment. The more the better, right? One interesting point Mudo brought out when we're running through this presentation is your utilization gets affected, right, guys? So if you carry a utilization for several months, you'll notice your credit score will come down. Remember we talked about that in the last month's presentation. So I just want to add that as well. Anything else?
Yeah, I think that's an important point as well in terms of credit, that yes, you're making your minimum payment and you think that you're not missing any payments, which is good. Your score is not getting affected in that sense. But then there's another category that we talked about before, which is utilization, which is the ratio between the balance that you have and the limit that you have. So when you're making those minimum payments, your balance is still high. So you're not paying off enough to make that balance come down enough. So that ratio is still high. So your utilization is high, which means your score will be affected sometimes to an amount of almost 100 points just because of this simple utilization fact that not a lot of people know. So yeah, when you are considering buying something, think about paying off as much as possible, not just the minimum payment, but as much as possible so your utilization doesn't get affected and your borrowing ability in the future. Let's say you want to buy a car or get a mortgage in the future, you don't want that to affect you and come back to bite you. Yeah.
Perfect. And guys, I just want to remind everyone, if you have any questions, within these topics or anything related to your, finance in general, definitely put it on the chat. We will cover it at the end. So anybody that has any questions? Oh, everyone in meeting. Okay, I noticed something now. Please put your questions on the chat. I was sending it to you privately. Please, everyone, put your questions in the chat there, and hopefully we can spend some time at the end and go through it. Okay. Just kind of talked about earlier. This is just another example. Same thing, right? Minimum, credit card balance is 5,000. Everything here is the same. The only difference is the payments per month. This person paid $200 per month. This person is paying $460 per month. The interest paid is nearly triple the amount. So the amount saved is about 880. It's just another example, that's all. Okay, but very important, do not go after your minimum payments, at least double them, but try to get to that 20 or 30% of your credit card balance instantly per month, okay? So the rule of 72 here, we can have Mataz jump in, and I think you might have to unmute yourself. There you go.
Perfect. So rule of 72, again, another rule by Einstein. So he said, we're not going to go into the Y72, the formula, but just memorize this. 72 divided by your rate of return will give you how long your money will double. It's just as simple as that. Just memorize it, and then whenever you see your investment return, use it on the denominator. So here he said 72 divided by your annual rate of return will give you how long your money will double. So we always go with the average return because the 1 year performance is not indicative of how the other years will perform. So when you talk to some people, for example, they say, oh, last year I got 20%. Okay, 20% last year, that's great, but that's not your average return. Your average return should be like the past 5 years, the past 10 years, and so forth. So last year will be one of the years that you're gonna have in your average. So so last year, for example, was 20%. The year before was minus 10%. The year before was 8%. So when you add them all together, let's say your average was 10%. So if you say your average is 10%, then 72 divided by 10, that gives you 7, right? So that means your money will double in 7 years. So as you see here in this schedule below, you see the different returns, and then it gives you the number of years to double your money. So if you're getting 10%, 72 divided by 10, that means your money is doubling every 7 years, 0.2. So we can just say 7 years. If you're getting 6%, then your money is doubling every 12 years. You're getting, you're putting your money in the GIC, giving you 2%, then you see you're doubling your money in 36 years. So as you see, obviously, the higher the return, the lower the number of years to double your money. So investment returns in general will be anywhere between 4% up to the 12%. 18 and 24, these are not reasonable returns in the financial markets for regular people. Some hedge funds can do it, but these are very outliers, and very small number of hedge funds can do it. Not every hedge fund. For example, Renaissance Capital, that's one of the companies that has done better than these numbers, but a very small number that can do that. So the average return between 6 to 12%. These are the between 4 to 12%. This is what investors should expect. And then that gives you how long your money will double. And then remember also what's really important to remember, the next double, because this is compounded growth. So the next double wouldn't be on your principal, would be on the last number to double. So for example, let's say you invested your money at an investment that's giving you 10%. So you put, let's say 100,000. So in 7 years, your money became 200,000. And then your investment continued to grow at the 10%. So in the next 7 years, the double wouldn't be on the initial 100,000. It will be on the last number. So the last number was 200,000. So the double will be now on the 200,000. So 200 will become 400. So if you look at it on, like, you know, from the beginning, from the first 100,000 over the past 14 years, the 100,000 became how much? 400,000. The 100,000 became 400,000 in 14 years, because the first double was in 7 years. So 100,000 became 200. And then the second double from the 7 years into the 14th year. So the 200 became 400. So from 100,000, you got to 400,000 in 14 years.
Perfect. I also want to highlight, you know, there's another way to look at the rule of 72. Remember, there's always two, right? There's the good and the bad in compounding, right? And if you are, let's take a look at this, right? You know, housing market has been going up. Well, these days, again, it's an outlier, right? We're seeing numbers of 12 and 18%, but really, realistically, you expect 4 to 5% growth in a home, right? And even if we just look at 4%, you can imagine 18 years. So if you just have a newborn right now, and you're seeing the prices are already kind of high, right, in the 900, 1 million range, then by the time that person is 18, right, and maybe even willing, you know, can start even considering to look at places, they would have doubled, right? So they're going to be shopping around for a $2 million home regularly on average, right? This is just going to be a norm. I know it's hard to grasp that concept, but that is compounding, right? There's nothing special. It's just a 4% growth. But we saw recently folks that have bought even 5-6 years ago saw about a 10 to 12% increase. So they probably saw their home double in value. And they're like wondering, well, what happened? Well, it's because 6 years went by and they've been seeing about a 12% increase in just the last few years. Again, a lot of it was, you know, COVID related and whatever, but this is probably not going to happen, but very, very, you know, expected is a little bit over inflation. So 2%, you know, a little bit over inflation is the 4% mark there. So in about 18 years, home prices will double, guaranteed. Absolutely, no doubt about it. And that's just a minimum, right? So that tells you right there that, oh my goodness, I am playing catch up. I myself working that 9 to 5, I'm playing catch up. So you have to start looking at ways to put money aside in your RSP and TFSA. You have to, and you have to let your money also work with you, right? And that's why we brought Mu'taz. We went out of our way to bring you guys a direct network. There's absolutely no excuse. You can at least minimum just contact them and say, what can I do? You know.
Yeah. Yeah, that's a good point, Mohammed. And I think another thing is some people might question, like, and say, like, I don't have enough income. Where can I say? Where do I get that money from? And I think one interesting thing that I personally started experimenting with maybe a month ago is I downloaded the app Wealthsimple. So this is basically an app that you can use to trade and invest your money. So I actually started doing this just because I found myself when I'm out, I'm always, you know, ordering coffee, sometimes donuts, like, you know, spoiling myself every now and then. But then I started this experiment where I would say, like, I want to buy coffee. How much is that going to cost me? $5. Okay, instead of buying that coffee, I'm going to put that $5 towards the stock. So I started doing this, and it actually had two benefits. Like, the first benefit was I actually stopped, like, you know, ordering too much coffee and eating much. Like, my weight is actually getting better. I'm losing weight. But in addition to losing weight, I'm actually gaining, like, wealth, right? So at the end of the month, I found that I have over $300 in this Wealthsimple account that's probably going to be growing for the next 20, 30 years. And Martez was talking about the compound effect, that if, like, that $300 in 20 or 30 years can be almost $1 million. So just by a simple act of, instead of buying that coffee when you're out, maybe just do it at home, make your coffee at home. And in 30 years, when you come to retire, that coffee turned into a $1 million investment that you can comfortably retire on. So so when I get the question that where do I get the money from, I will challenge you actually and say that there are ways to get that money. Just look at your budget, look at your expenses. What are things that you can replace or eliminate altogether that will help you retire in the future.
Perfect. And thank you guys. I'm seeing some questions that are coming in the chat. Feel free to keep throwing questions in there. We will spend some time and go over it. Okay. So with that said, we're going to do a quick little market overview here. This is just a high level just before we get started with the questions. All right, guys. Mudo, take it right away with the interest rate changes that we've been seeing. It's been a crazy one out there.
Yeah, sure. So some of you might have noticed that in June 1st, there was another Bank of Canada announcement rates. So basically the Bank of Canada, 8 times a year, they have an announcement and they come out and say, this is the new overnight rate. And so back in April 14, there was an increase of about 0.5%. And now in June 1st, just a few days ago, there was another increase of 0.5%. Keep in mind that we're still 0.25% away from how it was before COVID, but we are still expecting increases in rates. The main reason is there's a quote that I have down there that rates will keep rising until the fear of a recession is more than the fear of inflation. So what the Bank of Canada is trying to do right now is to target inflation. Inflation is very high right now in Canada. It's almost 6.8%. It's even higher in the US, and usually Canada and the US are always catching up together. So one of the ways to reduce inflation is by increasing rates. So people stop spending a little bit. And when they stop spending, that's when inflation might come down. So the next announcement is in, I believe it's July 14. Unfortunately, because inflation is still high, they do expect another increase. Nobody knows how much, but some people are speculating that we should expect, like within this year and the next, another total increase of maybe 2%. So why are we talking about the Bank of Canada interest rate? Because this is very important for mortgage holders today that have variable rates, because variable rates always follow the Bank of Canada. So whenever the Bank of Canada, let's say, increases by 0.5%, then your rate will actually be increased by 0.5% if you have a variable rate. Of course, if you have a fixed rate right now, it won't be affected until the time comes for renewal, because fixed rates actually depend on the bond market. They don't depend on the Bank of Canada. So fixed rates, they're already on the higher end. There might be some increases coming on the fixed rates as well, but it won't be as high because it's already on the higher end. For those of you who want to ask about rates, if you're talking about variable, I would say it's the range from 2.5 to 3.5%, depending on the lender, depending on what type of product depending on the down payment. There are multiple factors here. And for fixed rates, we're looking at a range of maybe 3.9 to 4.9%. It's still on the higher end, which is pretty normal between variable and fixed. Most of the time, there's always a difference of around 0.5 to 1%. So that's with regards to the market. We'll wait and see what happens in July 14 and go from there. We'll keep you posted.
Perfect. Thank you, Mudo there. So now let's take a look at the housing trends that we're seeing. I know a lot of folks have some questions there. What is going on? So we're going to look at something called a sales to new listing ratio, right? This is a very important metric that we see here in the industry. And it's exactly that, right? So sales is how many things have actually transacted, right? So when a property goes on the market and it actually transacts, we call that sale, right? New listing is just that, how many new listings came to the market. So the numbers are roughly about 7,200 came to the market and about 18,000 came to the market and about 7,200 transacted. That was just last month's numbers. And that gave us the 39% number that you're seeing here. Compare that to last year. Last year, we saw 64% of those units, right? So what do these numbers mean, right? So I kind of put a little summary down here. If anything over 60%, it's considered a seller's market, right? So that's basically what we've been seeing during COVID. Any property that comes basically to the market, 2/3 of them will sell, right? No matter, and that's everything, right? Ones that are priced really, really high, that's it, sure. Ones that are really low, they have the multiple offers, that crazy bidding war that you're seeing. All of that was happening during essentially most of COVID. up until about February, March. March, we started seeing things come down as interest rates were starting to increase. The government started jumping in. They said foreign buyers, 2-year ban, and they added all these rules. So they started to kind of had people push off the pedal and say, okay, well, hold on. You know, should we get into these wars? Should we go do the bidding wars? Should we, you know, go to these like open houses? And we saw a big slowdown last month. So now we're seeing it 39%. So what we said, 40 to 60% is balanced. Under 40% is starting to look like a buyer's market, right? It's still in that cusp, still not a strong buyer's market. And that's simply because the amount of the inventory is very low. So usually in a buyer's market, you also see homes sit on the market a lot longer. We're only seeing them stay for about 18 days. That's still not considered enough to be considered a strong buyer's market. Usually you have a lot more options. So when you look around in your neighborhood, you're probably only seeing maybe one for sale sign, where before, if it's a strong buyer's market, you'll see 4 or 5 different options you can kind of choose from. Okay. What does that mean in terms of prices? So year over year, we did see an increase. It's about 9%. But here's what's interesting. I want to show this number more, which is what's going on month to month. This is like a focus zoom on what is going on today. And we see that from April, there was a 0.5% increase. June 1st, there was a 0.5% increase. This one is the May numbers, so it doesn't show you the more recent rate increase that Mudo just mentioned, but the anticipation of the rate increase is there. The media has made sure to put it out there, so everybody is anticipating it. So the numbers still do have some of that June effect in there, right? And we're seeing a 3% drop in actual average prices, right? Year over year is still up. Overall, it's staying up. And if somebody's ever wondering what is going on with the housing market, is it ever going to go to pre-pandemic numbers? I don't think that's going to happen ever, no matter how strong of a rate increase they do. And my reasoning for that, and some folks in the industry will agree, is the inflation, right? Usually homes tend to at least keep par with inflation. They usually outperform inflation by a little bit, right? So if inflation is at 2%, you can expect your home to grow by at least 3.5%, 4% year over year kind of thing. So inflation, like we talked about, is nearly 7%. So if you're expecting some sort of dip, yes, you might see home prices come down a bit. That we're going to see, but inflation in general is going up. So the home prices are expected to be at least 7% more than what they were of last year and the year before that during pre-COVID times, right? So that's the kind of economics of it. Okay. One thing we like to always end off here, guys, is some useful links, right? There are no like secrets here we're keeping. This is exactly the same things we use. I actually have a Borrowwell account. I have a Credit Karma account. I actually, these are essentially some useful links if you want to get a free credit report. RateHub.ca is a good one if you want to just kind of keep up with what's going on with the market. Here's our personal websites that we've added. Mine can have like some affordability calculators like Mudo's. So all of these, we're gonna put the full links for you guys if you need to just clickable links. But these are all useful tools. There should be no reason nobody knows what their, for example, what their credit report looks like. And more importantly here, if you have any questions, please do put it on the chat. And we're gonna go over some questions. Okay, guys? So here's the contact information for those that need it. Grab that number, especially Mu'taz there. He's our guest for this month. Thank you, Mu'taz, for coming in and supporting this presentation and giving us your knowledgeable insight there. Appreciate it, man.
Pleasure. It was very very useful, guys. Like you guys shared really very good insights, and I really appreciate it.
Thank you. So I only saw 2 questions, which I'm surprised. Not a lot of questions today, but we're still gonna go over them. And guys, if you have any questions, just put it on the in the chat there, and we'll definitely go over them. Don't be shy. So thank you very much for this presentation. I would like to know what is the best investment option if I have $10,000 in the TFSA account. All right, feel free to jump in, guys. But the way I would go about it, $10,000, I'm not sure will be enough to go to folks in the with like Edward Jones and such like that. But I would always recommend folks these days to go to ETFs. ETFs are basically exchange funds. Let's say you don't know what to buy in terms of a stock, right? Let's say you like maybe Apple, but you don't know if you want to just buy just Apple, right? So then you say an ETF, basically it will be a bundle of stocks, right? So you can have an ETF that tracks the S&P 500, the 500 biggest companies in the US, or you can have an ETF that covers the Nasdaq, so it's more tech stocks, right? So it'll have, you know, a good chunk of it will be Apple, maybe 3-4% of it might be Apple, but it also has everybody else, right? So it has Amazon, it has Microsoft, it has a bunch of the other big players, and you know, another 100 or up to 100 different stock companies. So it might be nice because then it's a little bit more diverse, right? So if there's one issue with one company, then at least your investment is kind of protected. The concern with some people, the argument with ETFs are that so if you get the good and the bad of all the companies, right? So in general, though, we talked about it, markets are expected returns of 8. I think S&P averaged close to 10% in the last 20 years. So in general, it's still better to put it in some sort of ETF. They offer very low fees. And for accounts about $10,000, $20,000, that would be your best bet. Once you get to the larger amounts of the 50,000, 100,000 plus, you definitely should look into, you know, personal finance advisor like Mu'taz here, can really dig in for you and kind of create a plan for yourself and your family. Feel free to jump in, guys. I'm freestyling.
Just if I can just add something. Well, actually, I do also work in investments with TD Bank, but my answer for this question would always be it depends. It depends on what's your goal with this money, because I always encourage a goal-based planning, goal-based investments. So what would be your goal with this money? How soon would you need to use this money, and how comfortable are you with the market volatility, and how much you are sophisticated with investments? Can you do it by yourself? So I usually and always advise all the people that they're looking for investments to go for a financial advisor or planner, because it's not about just increasing the numbers. It has a lot of consequences. It has a tax consequences. It has maybe insurance needs, a lot of stuff actually. So always reach out to the professionals. They will be most of help to you, because there is a lot of investment options. There is a lot of investment accounts. There is a lot of on your side. They can help you discover your blind spots on that. So always reach out, and I think that would be the best answer for that. But I would never say that, okay, you have 10,000, 20,000, 100,000, you better go with this or with that, because everyone is different. Everyone's circumstances are different, and goals are different as well.
100 times better answer there. Thank you very much, Hala, for jumping in. I myself, I'm just a real estate agent, guys. I'm not a financial advisor by any means. So definitely, that's why we have these guest speakers, right? Mudo and I are more involved in housing, you know, mortgages and such. The guest speakers that we have, we try to bring folks that are experts in tax, folks that are experts in personal finance, financial advisors. So that's why we put the contact numbers there. And yeah,
I will just add to this. Actually, both of you guys are correct. In terms of the definitely, like Hala, what she mentioned is time horizon and risk tolerance is very important. So this person who's asking this question, they should ask themselves first, like, you know, what's the time horizon for this money? Is it 5 years or 10 years? Is it 20 years? So that speaks to the goal. Like, you know, like, what's this goal? Is it for retirement, or is it for buying a house or whatever? So time horizon, goal, and then risk tolerance. Are you okay with like losing 20% or 30% in the short term if you have a longer time horizon? So absolutely, these are very important questions that the person should ask themselves first. And then number two, as Muhammad Ali mentioned, like, you know, like a lot of financial advisors wouldn't work with like smaller amounts. So if you face like that doesn't mean like you shouldn't go and ask. Like, you should go and interview a few and see, like, you know, if one of them will work with you. If they say no, like the amount is below the threshold, then in that case, using ETFs will make sense, because at the end of the day, you need to invest this money with an advisor or without. Like, you know, if they said, like, you know, we cannot invest this money for you, then you need to attend these seminars and learn and ask questions. And then passive investing is like a very old school of thought, and it's available for the people who cannot have access to advice, because not everybody has the ability to work with the financial advisors. So in that case, then if that's the case, then just ETFs will make sense.
Yeah, So I want to clarify here, just so that people are clear. So some folks like Edward Jones or some of the bigger firms, they might have like limit thresholds on what you can go and approach them with, and I think that's where it's coming from. But to Hala's point, I do like the fact that both are available. You can still reach out to Mu'taz or Hala for anything, regardless of if it's $10 or if it's $100,000. Reach out and ask the questions. At the end of the day, it's your money. Let it work for you. Don't just sit there, work your 9 to 5 and think that's enough. It is absolutely not enough. If you're going to work every day, it is not enough. Your money needs to work for you, right? Just so you don't have the rule of 72, kind of backbite right at the end and find that prices are all so expensive and you're wondering why the wages cannot keep up, right? It's not meant for the wages to keep up. It's unfortunately designed that way. Keep working. So it's the money has to work for you, right? And that's what's going to get you out of there, and build that wealth for yourself and your family. Okay. Keep the questions coming, guys. I just saw another one here pop in, which is what's the best type of savings account? I actually don't know how to answer that. I would say the best one is TFSA and RRSP, but if there's other ones that you guys recommend, feel free to jump in.
Yeah, it is a tax-free saving account, RRSP, depending on what you're saving for. If you're saving, again, all these things, like you have to set up the goals, right? Like the goals are one of the most important, like the most important thing actually is the goal. And then based on the goal, you will build your investment strategy. So you put the goal first. So depending on your goal, if your goal is like for retirement or something like long term, then RRSPs will make sense. If the goal is short term, like a trip to Sudan or a trip to any or saving for a car in the next 2 years or whatever, then a tax-free saving account will make sense because whatever you invest within that account, then it will be tax-free. Let's say you put the money into, let's say you have a short time horizon, so then your options are limited. You only have to invest in GIC or money market. So in that case, you put it in a tax-free saving account, you're getting 2% interest or whatever. That 2% interest when you withdraw the money is tax-free. You don't have to pay any taxes on it. If your time horizon is short, longer time horizon, then RRSP will be your best bet.
I think that's an excellent answer because I do get the question sometimes is, I want to save my down payment. Some people think of saving their down payments by buying stock. That's not always the best option because if you're buying ETFs and like investing in companies like the S&P 500, that means you're actually investing for the long term. You're looking 20, 25, 30 years down the road. But if you're saving for a down payment, let's say 2 or 3 years, then by the time you come and take that money out, the market might be experiencing a downturn, right? So your down payment money would actually might have become reduced just because of that downturn. So if you're saving, for instance, for a down payment, this is a short-term plan. So maybe putting it in, as Mu'taz mentioned, putting it maybe in a GIC or money market where at least it's not losing due to the inflation might be a better plan, especially because it's a short-term plan. And like Hala mentioned, it's all about your goals. So is it long-term or short-term? Yeah.
Perfect. Yeah. Thank you, guys. I hope that answered whoever asked that question. I hope that answered your question. Yeah. Is a fixed rate always better than a variable rate, or does it depend on other factors? Excellent question for whoever asked that. We have coincidentally a mortgage guy here for you.
Yeah, I think an excellent question. It would also depend, right? So whenever it comes to fixed rate and variable rate, everybody knows one of the differences, which is when you have a fixed rate, that means your rate will be fixed for the term of the mortgage. So let's say you take a mortgage with CIBC. CIBC will tell you this is a fixed rate for 5 years. So for the 5 years that are coming, your rate, let's say your rate is 3%. Your 3% rate will remain the same for the 5 years. When it comes time for renewal, you will negotiate a new rate. With variable rate, it's a bit different. Your rate will not stay the same. It will go up or down depending on what we mentioned, which is the Bank of Canada overnight rate. So if it goes up, your rate goes up. If it goes down, your rate goes down. So this is the main difference that most people know. The second difference, I would say, comes down to your payment. So there's a difference between your payment and your rate. So with fixed rates, because your rate is fixed, your payment will also be fixed, right? But when it comes to variable, there's actually two types of variable. There's the variable rate with a fixed payment. So the rate does go up or it goes down, but your payment still remains the same. The only difference is the portion of interest that goes, towards interest will be different. So if interest rates go up, the portion of that payment that goes towards interest also goes up. If interest rates go down, the portion of interest, like the portion that goes towards interest, also goes down. But your rate still remains the same. This is something that not a lot of people know, which is very important. You can have a variable rate, but still have your payments not change. So that's an advantage for people that they want the lower variable rate because it's lower most of the time, but at the same time, they don't want their payments to increase, right? Maybe they're investing in a property and they have a certain budget that they don't want to go above. So having something like that would also be beneficial. There are variable rates that have payments that go up or down depending on the market and depending on rates, of course. And these are called adjustable rates. So if rates go up, your payment goes up. If rate goes down, your payment goes down. So depending on what your goal is and what you want, if you're comfortable with rates, your payment going up or down, maybe an adjustable rate would be for you. But if you want the advantage of having fixed payments with a lower rate, then maybe you can actually choose a variable rate for that. The last difference that I would mention is something that we call prepayment penalty.
Hello?
Ahmed,
Yeah, Mudo, you cut off. So prepayment penalty, guys, I'm gonna jump in here. Prepayment penalty essentially is if you're looking to buy a place, but you're not sure if you're gonna stay there for a long time, make sure you go variable. Oh my goodness, is that a costly mistake? So, for example, if you're
And,
Mudo, sorry, you cut off there. Missed like half what you're saying. The
oh, sorry.
prepayment penalty, I think, is where you left off.
Okay, I'll double back on the prepayment. So can you hear me now?
Yes.
yeah,
Oh, okay. So when it comes to prepayment, what is a prepayment penalty? A prepayment penalty is what happens when you end your contract before it ends. So let's say you have a 5-year term with RBC. Before that 5-year term ends, you decide to sell your home. You decide to do a refinance. Any of multiple scenarios that can actually lead to a penalty. So this penalty amount depends on whether you're on a fixed rate or a variable rate. And most of the time, the penalty can be 6 to 10 times higher if you're on a fixed rate. This is something that might be uncomfortable for most people, and some people don't know it, is when the time comes that they want to sell their home or they want to do a refinance, they're hit with this huge penalty. Let's say you have a 300,000 mortgage. Now you have to pay 20,000 penalty just to get out of that mortgage, just because you're in a fixed rate. If you were in a variable rate, that penalty might have been closer to 2,000. So with variable rates, you also have flexibility. So if you're someone that's thinking down the road, I want the flexibility to sell my home to do a refinance, then variable might actually be more appropriate. But if you're someone that's very, very risk averse, when the news comes out and you hear stuff like, interest rate goes up or down, you can't sleep at night, then I have a friend that calls it the pillow test. So can you sleep at night knowing that your payment might go up or down? If you can't sleep at night, then just go fixed. But if you're more of you can handle risk, you want to kind of get the best of both worlds, then a variable rate might be actually for you. So the pillow test will actually determine that.
Can I challenge you there, Modo? I have a quick question. Like, is there like a rule of thumb? They say is if you're able to get below 3% or something like that, go this way or go that way. Is there some sort of, because I know historically variable is better, but like we're seeing interest rates kind of increase now. It's kind of high. If this was a question, asked 2 years ago, 3 years ago, the question is no doubt, go variable. Historically, it's been better, but now we're seeing interest rates are kind of climbing. Has that changed? Like, what would you get for yourself? Would it be more variable?
Yeah, that's an excellent question, actually. If you're only looking at it from one angle, which is like the difference in rates, you might say yes, it makes sense to go fixed because variable rate is on a climb. It might actually reach a point that it goes above fixed before it starts going down again below fixed. And that's when the question will be, what do I do? You might think that yes, fixed is the better option, but still you do have to factor in the other factors. Like you do have to factor in the prepayment penalty, right? So even if, let's say, you get to a point where your variable rate is more than your fixed rate, but when the time comes that you actually have to pay a penalty just because you're selling a home or you're doing a refinance, the net effect will actually still be, most of the time, still be in favor of variable just because you paid that penalty. So the question becomes, why am I factoring in the penalty if I don't think that I'm going to sell within the next 5 years? I would say because statistically speaking, 6 out of 10 Canadians break their mortgage within 38 months. So that's 3 years and 2 months. So most of the time, even when you don't expect it, there's always something triggering you to sell or refinance. It could be that rates are even better right now, so I want to refinance and get a better rate. I want to refinance and take out some equity to buy a new home. I want to refinance to help my children to buy their home, or maybe even to help support my business. So there's multiple scenarios that will lead to that. So having that flexibility of variable helps you in determining, and like when the time comes and you do decide to break your mortgage, you're not hit with a heavy penalty. But then again, I'll always say, like, how comfortable are you sleeping at night knowing that there might be a change in rate here and there, but down the road, the net effect will still be in favor of variable. So that is an excellent question. I myself, I would still go variable. I have a colleague that has this saying that your life is variable, so maybe your mortgage should be it as well, right? So you never know what happens in life that would lead to you breaking your mortgage. So having that flexibility is also important. Yeah.
That's a good idea.
Mohammed, just a quick question. Could you comment on home equity line of credits? Like, are they variable rates, or are they fixed, or are they in between? Like, what's the deal with them?
Excellent question. I would say a home equity line of credit is similar to any other line of credit. Only difference is it's secured to your home. It's always variable, so it always follows the prime rate. It follows the Bank of Canada. So if rates in Canada go up, your interest rate with your line of credit will also go up. So I don't think there are fixed rates when it comes to line of credit. I would say 99 or maybe 100% of the time it's a variable as well, but it's usually higher than your normal mortgage rate. So let's say you have a 3% mortgage and you have a line of credit as well. That line of credit will likely be higher by maybe 2 or 3%. No, sorry, not 2%, by maybe 0.5 to 1% higher than your normal mortgage. And this is a question that we get, is when you want to pull equity out of your home, there's always 2 ways to do it. You can do a refinance and have your whole mortgage under that, let's say 3% rate, or you can just take it out in a form of line of credit. But in the line of credit, you're paying a higher rate. So why would I take a line of credit with a higher rate? I would say if you're not planning to use your line of credit in the near future, then it makes sense to maybe leave it in the line of credit. But if you're going to use that money in the near future, maybe for a renovation or something, then it might make more sense to do a refinance. So it depends, of course, on your situation. But excellent question, Matas.
We have another question here. Well, this one for you. Can a homeowner change from variable to fixed? The second question.
Yeah, I get that. Another great question. Yes, the short answer is yes. Always when you have a variable, you always have the option to lock into a fixed rate. But I don't think, especially in this market, that it's the right move to make. Because let's say right now you have a variable rate of maybe 2.5%. If you lock into fixed, you're immediately locking into a 4.5%. So you're immediately, I guess, hitting yourself with a 2% increase by doing this. So I wouldn't recommend locking into fixed. It will cost you a lot more interest compared to if you stay with the variable, and your variable, it will increase, but during that whole time that it was increasing, you were still paying lower interest than the fixed. in this market, I wouldn't recommend locking into fixed, but if someone has a specific scenario that they want to discuss, I'll be more than happy to go through it. Yeah.
Yeah, I think you mentioned like the payment plan is a big one, right? Like that's what affects a lot of people to switch. Like you might have a fixed right now, you want to jump into a variable at a better rate. We saw a lot of that during COVID because variable rates were so low. But a lot of folks had penalties of, 15,000 or even higher, right? That they had to basically pay so that they can make that transition over.
Exactly, exactly. Unfortunately, that's what happened to a lot of people. They were suddenly hit with this huge penalty, and it didn't make sense to change. So we might actually experience this. Let's say if you take a fixed rate today, and in 4 or 5 years, rates actually start to come down. You want to take an opportunity and actually switch to a variable, but then you discover a higher penalty. So I would say penalties are always not discussed when it comes to mortgages, but it's a huge it should be a huge part of your decision making.
I also know, Mudo, you guys do offer services where packages where if you do the switch, sometimes you get cashback options, right? So kind of offsets the number. So basically, each person's situation is going to be different. You're probably going to have to sit down with, somebody in like Mudo in the mortgage industry to kind of look at your case specifically and make sense of it. And see if there's any kind of way of like cashbacks and stuff like that that kind of help alleviate any penalty costs and stuff like that. So, excellent question.
Yeah.
Would you recommend fixed payment on a variable rate instead? I'm not sure if you answered that portion.
Yeah, that's a good point. So when it comes to variable, I just mentioned that there's two ways. Like you have an adjustable with payments fluctuating, and then you have what's mentioned here, a fixed payment on a variable. So it would depend on your situation. I personally like this option. I like using the opportunity of having a variable rate where my if I have a penalty, it won't be high. But at the same time, my payments are not changing. So I do think it's an excellent option. Not all banks and all lenders have it. So if you are thinking of it, it would be dependent on the lender that you're going to. But I do think it's an excellent option, especially in this environment where rates are going up. So even if rates are going up, you have the peace of mind that your payments are still the same. Yeah.
Perfect. So we're going to segue here to the last question that we got, which is better cashable or non-cashable GIC? What?
Depending on time horizon, because the non-cashable GIC, normally they have a lockup period. So you have to lock the money for a period of time. 1 year, 2 year, 3 year, 5 years. These are normally the terms. If you use a non-cashable one, normally the rate will be higher, but then you cannot get your money back until the term is done.
What is the difference between cashable and non-cashable? I've never heard those terms.
So the cashable is you can cash it out any time. It's just like a high interest saving account.
Okay.
You need the money tomorrow, you can cash it out tomorrow. Normally the rate on them will be lower, but the regular GIC is non-cashable. So normally you buy it with a term, 1 year term, 3 years term, 5 years term. Obviously the longer the term, the higher the interest rate. But then if you need the money in the middle, like you can't get it back. It's locked in.
Okay.
Normally they use that money and put it in a mortgage or something like that. So that mortgage is locked in, so you can't get it back. So depending, like, on your time horizon, like, when you're gonna need this money, based on that, you can pick which one you're gonna go with. Because obviously the regular GIC, which is non-cashable, has the higher interest rate.
As a financial advisor yourself, do you recommend GICs or do you suggest folks maybe consider like ETFs as a better option, or like what do you recommend? I'm assuming.
See, that's a great question. These investments, each one of them has a purpose. Like you cannot say, for example, just a blanket statement that all GICs are bad because they pay you 2% or 3%. Invest in the stock market because it gives you 10% or 11%. You cannot say a blanket statement like that because each investment vehicle has a purpose. So the GIC normally is good for somebody who knows when they're going to need the money within the next 3 years. So let's say somebody is buying a house in the next 3 years. This person should never invest in the stock market because they could lose that money. They have a very short time horizon. So in that case, a GIC will be their best bet. So in this case, you would say, thank God there's a GIC, because otherwise your money would make no money at all. So the 2% or 3% is better than nothing. So so the GIC in this case will play a good role. Somebody who's like, like in their like very old in age, and they know they might have 2 or 3 years and before they die. So in that case, they gonna put the money in GICs because they know their time is limited and the money will go to their heirs. So they're gonna inherit the money. So they don't want to save them from any market fluctuations. So they're gonna put the money in GIC. So they have their uses. Like any product that you see in the market, it has its uses.
Excellent point. And I want to add to that question, Martez. Like I was thinking, like even for myself, like what is your opinion in emergency funds? Let's say I want to put aside emergency funds for myself. Where do you suggest a good option to put those emergency funds? Because obviously, for instance, I might not want to put them in an ETF because I might need it. So, what's your opinion there?
That's a great question, Mohammed. So, the emergency fund, there is two schools of thoughts about it. So they say sometimes, so the number is 3 to 6 months of expenses. So they say between 3 to 6 months of expenses should be in an account that's easily accessible. So let's say if somebody is spending a month, let's say 4,000 a month, then the range should be between 12,000 to 24,000 in cash. So this money, because it's emergency fund, you need to have access to it immediately. So then in this case, non-cashable GIC wouldn't be an option because that one is going to lock you for a period of time. This money, you need access to it. So it's going to be either in a cashable GIC or a high interest saving account or like a money market, like anything that doesn't have any lockup period, anything that you can access it right away. So that will be your best bet to have something like this that's accessible, that gives you like 1 or 2% interest, and then you can cash it out anytime you want. The other school of thought would say that any money that you have it work for you, and then have access to a line of credit. So that line of credit with very low interest rate, so 3%, 4%, something like that. And then if any emergency happens, then you can just take the money from the line of credit, use that money, and then pay it off, or just pay the interest only, like whatever you want to do. So that's another school of thought, depending on the person, like risk tolerance. So yeah.
Perfect. Yeah. Well, that's it. I don't see any more questions, and I definitely do want to thank all you guys for watching.
Muhammad Ali, just 1 second.
Yeah, go for it.
Before we close, yesterday, I want to throw the same objection that I threw at you yesterday about people saying, oh, like I cannot save enough because I have a lot of bills. I'm sending money back home.
Yes.
Like life is expensive. I cannot save. So what are you gonna do, Muhammad, in that case?
Yeah, if this was directed to me, so the definitely talk to a financial advisor, right? It's the lessons that we took from today. You do have to sit down and actually look at where your expenses are going, right? A lot of times people are worried about their, I don't make enough money, right? I make $50,000, 10,000 goes to the government, and I'm living on the 40,000. Well, let's look at that 40,000. Right? It's hard to sometimes make more money, right? It's harder to go out there and just ask for a $20,000 raise. But you can actually go review, your bank statements, your credit card statements, and see where is the money actually going. Budgeting and talking to folks like yourself and Hala, Mu'taz there, who are in the financial advisor industry, right? You guys are sitting there, know a lot of tips and tricks that a lot of folks are doing. You can bring it down to your clients, and that's the idea here, right? That's the reason why we have these monthly talks to educate folks and really challenge everybody here to save. Know where to save now. Today we've covered a little bit on that, and basically let your money now work for you, right? So instead of you just working, making that, let's say, whatever salary, that your money is also earning you something, right? So hope that answered.
Yeah. And then Muhammad Mahmoud also, like use Muhammad Mahmoud's strategy also. He mentioned earlier, whenever there's he want to buy a coffee or wants to buy a sandwich, then he stops himself from doing that, and then he puts the money into his investment account. So that's like building wealth in general takes a lot of discipline. So following these disciplines, like definitely, like it's just a matter of time before you build a lot of wealth. It's gonna happen. You just have to be patient and with these good disciplines, you're going together.
Perfect. Thank you again, Mu'taz. Again, our guest speaker, guys. I know you guys are all muted. You can't clap or anything, but definitely, like or thumbs up on the chat there for him, for coming by. And folks, like, this doesn't have to be. I know it's been about a dozen viewers or so, right? Like, it doesn't have to be such a small, intimate chat. You guys can share this with anybody. We don't care who it is. It is not a Sudanese only, whatever. This is anybody, right? This is personal finance. It affects everybody. One thing we like to encourage is if you guys have teenagers of about 15, 16 or older, that is perfect for them to also watch. Reason for that is, myself and a lot of folks here haven't unfortunately learned this stuff in an early age. So a lot of folks just kind of went and maybe even put themselves in debt. I'll tell this for the mothers that are listening. When your kid goes to college or university, they give them a free T-shirt for a credit card. They don't. That's it. That's how you get your first credit card. Unfortunately, some of my friends, I was fortunate enough not to use it, but some of my friends did actually get into some really credit card debt. It's not much at the time, $1,000 or something. But the issue is your credit is so bad that by the time you graduate and you're ready to, start your new job, what do you need? You need a car, right? So you get your card so you can go to work. You find that you have like 500, point or 550 point credit score. And I know several people, not just one or two. I know several people that have unfortunately been stuck in that rabbit hole. So it's just educating, guys, right? This is all the purpose of this. Financial literacy is something we need to talk about. We should not stigmatize it and hide it, right? So share this link with everybody. I put here on the screen all of our contact info. Feel free to text. Screwed up Mudo's there. It's 647, guys, 901. I screwed that up. And yeah, thank you all again for watching, and have a good one. Enjoy the rest of your weekend. Stay dry.
Thank you, everyone. Thanks, everyone, for attending.
Thank you.
Bye.